Let's talk about why venture capital isn't always the best choice for SaaS founders and SaaS startups. There are 4 big reasons. Let's talk about one at a time. Number 1, there's often a misalignment of incentives between SaaS founders and the VC firms that back them. Now, keep in mind, when I talk about venture capital, I'm talking about institutional capital that specifically has a very intentional investment approach. They want to invest in the mega winners. They want huge returns of 1,000% or more in many cases. They're willing to lose a lot of money and have their businesses operate at a loss for a long period of time. And their goal is massive growth, major market share. And that whole approach can be really summarized by that saying called go big or go home, right? I want to be a billionaire or I want to be broke, right? What they don't want is to be a millionaire in the middle, right? And that's an important thing to keep in mind. So the incentives for a venture capital firm is to take big risks, swing for the fences, have a huge company, and that may not necessarily align with your best interests, right? Most of the founders and CEOs that I work with, they want to have a profitable business. They want to sell it. They want to personally capture a lot, if not all of the value that they've produced in terms of the equity. And they want to call it a day at the end of the day, right? They want to be able to sell the business and walk away. Now, creating a big business doesn't necessarily mean that you'll be able to profit personally, right? And that's where venture capital can be a very slippery slope. And that leads me to my second reason. The venture capital playbook breeds dependence on outside capital. Remember, VCs like extreme risk. They like high risk, high reward. What that often means is they want their CEOs to run businesses that they invest in at a loss. Take my money, grow fast, lose a lot of the money, and when you run out, guess what? You got to come back to me to get more money, right? And when you do, I invest more, but I also take more control and more ownership, right? So the model of operating a VC-backed company tends to be very aggressive. And there's an enormous amount of pressure to try to generate growth, even if market conditions are poor, right? So you have to be very, very mindful of the incentives. Does the VC want to achieve success in the same way that also works for you? If their approach is different, you want to be very mindful of that difference in incentives. Now, this leads me to my third area of concern about why venture capital isn't always the best choice. When a VC firm takes big risks, when they breed dependence on their capital for follow-on capital or outside capital, the third problem with venture capital is what I call excessive dilution of your holdings in terms of the equity cap table or the percentage ownership you have in the company. If you're constantly raising capital, that means your ownership percentage gets lower and lower. Now, under certain circumstances, certain ideal circumstances, that's not a bad thing, right? If you're always successfully winning and you're growing, you have no hiccups, everything's smooth, you're growing to 100 million in revenue, and nothing's gone wrong in the entire history of the company, right? Then getting diluted down as the company gets more and more valuable is not a bad thing. But in the real world, stuff happens, right? You get a bad economy, you get a pandemic, you get a regulatory change, you get some war in some part of the country or in some part of the world. Things happen that causes hiccups. When you are highly dependent on outside capital and you are not financially sustainable through operating cash flow, what that means is all those provisions, like in those contracts you have with these outside investors, all the fines, 8-point font clauses that all these attorneys argue over, they kick in when things go wrong. And when they kick in by taking more of your equity ownership to compensate them for perhaps a down round where the company's valuation and a follow-on capital raise is reduced. There are all these provisions that are designed to make sure that the VC investor stays whole at your expense, right? So it's super important to recognize and appreciate the math in those particular scenarios. And one of the big things VC firms sort of bank on or sort of benefit from, maybe would be a better way to say it, is that founders are so optimistic and so passionate and so visionary, it doesn't occur to them that something will go wrong. And so they don't mind giving away their own personal holdings in case something goes wrong because they're confident nothing's going to go wrong, right? And so the venture capitalists gladly will take those shares from you because you've offered them, because you're overly enthusiastic and not realistic that things will never go wrong. and they're protected and you lose a lot of the equity. So I have seen businesses that get into the several $100 million in valuation, in some cases $1 billion, and the original founder has nothing or very, very little. At the same time, I've seen companies that I've worked with that sell maybe at 200 million, right? Not a unicorn, not $1 billion company, but the founder walked away with $100 million, right? So it's very important to realize that the VC model is a very specific approach with very specific trade-offs, and you need to be comfortable with them. And if you don't understand them, get an advisor, get a good attorney, all right, who can help you navigate those and understand those trade-offs. Do not get into something you do not understand. So what are some alternative options that you can use instead of venture capital, right? So most commonly, you'll see a lot of software companies and SaaS companies start up in a bootstrap mode. Founder savings, maybe they take out a mortgage on their home, friends and family, things sort of within their personal network in terms of giving capital, okay? That's probably the most common way to start a SaaS company. The common way, the best way, the preferred way to grow a SaaS business is through operating cash flow. It's called making money from customers and then reinvesting it in the business, right? This has been true for 2,000 years. Not super sexy and fun, but hey, it works really well and it's been true and proven for like 2,000 plus years. So I love businesses that are able to grow through operating cash flow by treating customers right, making money from them, and then reinvesting it back in the business. And capital can be used to accelerate the process, but you never want to use outside capital to cover up the sins of your poor management decisions. That is a recipe for disaster, to make things worse and to blow things up for you personally, financially. So bootstrap, operating cash flow, those are great ways to kind of get the business going. Once the business is working, customers are happy, you know how to sell to them, you know how to onboard them, they're staying for a long time, then you can use capital to grow faster on a business that's already proven and oftentimes capable of being profitable within a few months if you had to make some financial adjustments, right, in case something went wrong. Now, the other capital sources I like are growth equity, where you are basically fundamentally are profitable or could be profitable, but you want to grow faster, right? There are equity investors that like that kind of investment profile, and they're looking to make 300% return in a couple of years, and they're not wanting you to run the business at a massive permanent loss. They don't want you to be highly dependent on outside capital because they don't want to be diluted. And oftentimes I find that SaaS founders I work with are probably better aligned with growth equity companies than venture capital companies. Other options include debt financing, bank debt, if you can get it, and usually you can up to a certain point once you're established. Really inexpensive, and sometimes they're personal guarantees, unfortunately, but it's a relatively low cost of capital, but the amount you can get is usually more limited. Okay? Venture debt financing, you can get a lot more capital, typically up to maybe 50% of your annual recurring revenue you can borrow, but the interest rates are high. They're significant. It's not ideal to use venture debt when you don't have a business that's profitable and working, because the debt service makes the problem worse. Where venture debt can be a useful tool is if the business is fundamentally profitable, you understand it really well, and you know how to go get more customers, but there's a time lag between when you go get a customer and when you make your money back. That is a good sweet spot for venture debt financing because interest rates are higher. But if you know your numbers and the risk is very low in terms of getting the money back, it can make sense financially. And then the last area would be around private equity. And so private equity typically is institutional investors that are willing to both potentially invest in the business, but also cash you out, give you a partial liquidity event where they're going to buy your shares, take over your shares in the company, but pay you directly for it. A growth equity company is going to write a check or a wire transfer that gets deposited in the company's checking account to grow the business. A private equity investor is willing to write a check or send a wire transfer to your personal bank account to buy your shares. So that money is going to you personally. It's not going to grow the business, at least not by default. And sometimes there are hybrids between the two where they sort of do a combination of the two. So these are some alternatives to financing the business, having it grow. I've worked with SaaS founders and SaaS companies for about 30 years or so. I am not a huge fan of venture capital. I like the other capital sources more. And venture capital makes a lot of sense in these very narrow set of circumstances, which are less common than most people assume or realize. So on that note, if you found this video useful, and I hope you have, please be sure to subscribe to my channel. If you have any questions or comments, leave them below and I'll be sure to answer them. Thanks, and everyone have a great day.